Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is one of the fastest growing beverage companies a good investment? In this video we will be analyzing if CELH stock is a buy. Could CELH, stock ticker symbol CELH, be ripe for a rebound? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on CELH. CELH began its journey in 2004. The company, inspired by the growing health and fitness beverage market, launched its first CELH drink. By focusing on functional benefits and essential nutrients, CELH gained traction. They offer a variety of sparkling fitness drinks with ingredients like guarana, green tea extract, and B vitamins. Today, CELH boasts national distribution across the US and is looking to expand further. Their headquarters are located in Boca Raton, Florida. Now let's look at the price action. Starting with the 1-year chart, we see that CELH had a CAGR of about 14%. Zooming out to the 5-year chart, we see that CELH had a CAGR of 107%. CELH had been a strong compounder for a long time, but the recent pullback may be a great buying opportunity. If we perform a backtest comparison of investing $10,000 in CELH Holdings Inc. versus the S&P 500, CELH delivers significantly stronger returns. A $10,000 investment in CELH would have grown to $354,596 compared to just $18,133 for the S&P 500, reflecting a much higher annualized return of 121.00% for CELH versus 14.14% for the S&P 500. However, this outperformance comes with considerably higher volatility. CELH exhibits a much higher standard deviation of 83.23% compared to 18.93% for the S&P 500, while CELH boasts a best year return of 941.61% compared to the S&P 500's 28.74%. Its worst year performance is also significantly more favorable at 4.71% gain compared to the S&P 500's 18.17% decline. Similarly, CELH experiences a maximum drawdown of -50.55% compared to -23.93% for the S&P 500. This higher volatility is further reflected in the Sharpe ratio and Sortino ratio, where CELH scores 1.31 and 3.11 compared to the S&P 500's 0.68 and 1.06 respectively. Overall, CELH outperforms the S&P 500 in terms of returns, but with a higher volatility risk. Now let's hop over to market share and take a look at CELH market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under beverage and see that CELH is categorized as a non-alcoholic beverage. Expanding the non-alcoholic beverage tab, we can see that CELH has the 4th smallest market share and is growing very rapidly. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for CELH, CELH, and see that the market share is just 0.17% out of the publicly traded food, beverage, and restaurant stocks currently in the market. While CELH attracts a small amount of food spend, it is growing its market share very quickly. The 5-year market share CAGR for CELH is an astounding 91.03%. This means that CELH's market share is nearly doubling every year. If we start in 2020, we see that the market share was 0.02%, 0.04% in 2021, 0.08% in 2022, 0.15% in 2023, and 0.17% over the trailing 12 months. This is just beautiful and consistent market share growth. Let's take a look at the fundamentals to learn more. Gross margin is 50%. This is very strong for a beverage company. Revenue has compounded at around 108% over the past 5 years and has reached over $1.41 billion most recently. CELH's revenue is growing very nicely, though the pace of growth has slowed a bit recently. When we look at cash flow, we see a 293% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 197% CAGR. As a result, free cash flow has grown at a 307% CAGR. Despite the quickly growing capex, Celsius has managed to grow their free cash flow to very strong levels. Weighted average shares outstanding have grown over the last 5 years, going from 223.3 million shares in 2020 to 237.3 million shares most recently. Celsius has been diluting shareholders. Shareholder dilution is the secret destroyer of portfolios, and it is unfortunate to find Celsius being a culprit of this practice. The good news is that given Celsius' large and growing free cash flow, I am optimistic that the dilution will end soon. Now let's view return on invested capital. Return on invested capital has grown from 13.7% in 2020 to 44.1% most recently. This is a great trend. I think Celsius can continue to improve upon their returns on investments for many years going forward. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 65 days in 2020 to 117 days most recently, Celsius has gotten less efficient over time. This is an area where I would like to see management really focus and improve. The good news is that Celsius is actively reducing their inventory, which should continue to help the value come down from its peak in 2021. Now, let's look at Celsius's debt. The net debt to EBITDA has fallen over time, going from -4.4 in 2020 to -2.8 most recently. I'm not really sure what to make of the change, but the value being negative and Celsius being profitable means that Celsius has more cash than debt. This is a great position for this company to be in. I really like this beverage company. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Celsius. It is a beverage company with a gross margin of 50%. The 5-year revenue per share CAGR is 102% and the 5-year free cash flow per share CAGR is 300%. Whoa, excellent gross margin and amazing revenue and free cash flow growth here. What is not to love? A return on invested capital of 44% is great and getting better. Next, the cash conversion cycle of 117 days is horrible but seems to be getting better. Concerning debt, a net debt to EBITDA of -2.8 means that Celsius is profitable and has more cash than debt. So from a fundamental standpoint, Celsius looks amazing. Now let's switch our attention over to valuation. Celsius is overvalued relative to the S&P 500 with a ratio of 2.2. The price to earnings growth, or PEG ratio, is 1.9, indicating that Celsius is overvalued relative to their projected earnings growth. Celsius is clearly a great company. They have managed to keep their costs low while having explosive growth. Market share has grown at a 91% CAGR and revenue per share at a 102% CAGR. Growth does not get much better than that. Love it. The biggest news for the company is the dramatic fall in share price. From an all-time high of $99.62 per share, the share price has fallen over 40% over a few weeks. A Motley Fool article explains the pullback in good detail. Shares keep following, making the valuation far more appealing than earlier this year. Clearly valuation has gotten much better with the pullback, as Celsius was very overpriced before. The cause? Distribution partner PepsiCo was shuffling around its product lineups in the quarter, apparently due to a general slowdown in consumer spending. That slowdown appears to be getting a bit more pronounced in June, giving more eyes to worry about a lackluster US consumer this summer. Celsius management said to expect some volatility in top-line growth this year due to the ongoing effects of PepsiCo inventory management, although Celsius stocking on shelves and retailer fridges is expected to remain healthy. This news was the catalyst for the sell-off, but what was actually reported will not have a lasting effect on business in my opinion. In fact, as I noted earlier, Celsius is actually selling off inventory, which will help improve operational efficiency. And while there is some concern that American consumers are slowing spending, I do think Celsius will continue to grow given its strong pricing power. I see this massive pullback as a great opportunity for interested investors to get into Celsius. In my opinion, Celsius is a great company with lots of growth ahead. This one is easy. For me, Celsius is going on the watch list. Many thanks for watching. What do you think about Celsius and its pricing power? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.